So we're going to be working on Parrot and Sing here. And notice, please, that we are in year 3. And what that means is that the excess of the fair value over the book value has been amortized once in year 1 and once in year 2. So the beginning balance that we set up for year 3 will have 2 years worth of amortization. So the net book value of that difference will be what we book. So let me just walk you through that and see what I'm talking about. So let's do the S entry. Let's get rid of the stock and additional paid in capital and retained earnings of the subsidiary. We're going to take beginning retained earnings because it's not at acquisition, and so the year 3 activity that flowed through retained earnings belongs to the parent, and so we're not going to eliminate that. And since positive numbers are debits and negative numbers are credits, we're going to be debiting here. So get our signs correct. Okay, so there is the S entry, and the other side of that will be the investment in. And we'll add those 3 up. And there's your S entry to get rid of the book value of the subsidiary. Now we're going to put on the net book value of the excess of fair value over book value for the assets acquired that weren't already that were of the assets acquired. So what did we acquire? Well, they tell us down here. Normally they would have us figure it out, but here they told us that there was a $3,000 was allocated to land. Well, land is not amortized or depreciated, so that will still be at the $3,000. Then they allocated $24,000 to equipment with a 6-year life. Okay, so 24,000 divided by 6, so 4,000 a year will be depreciated. So 4,000 was depreciated in year 1, 4,000 in year 2. So 8,000 of the 24 has already been expensed. So we are going to book the difference plus the 24,000 minus the first year's depreciation and minus the second year's depreciation. I got a typo in there. Let's fix that. Okay, I'm not booking the 3rd year because I'm going to do that in the year in just a minute, because that expense is going to hit this year, so I'm not going to put it in the initial setup of that asset. And then the other asset is goodwill, which is also not amortized, or at least not until FASB maybe changes their mind in a couple of years, but as of right now, it's not, and so the full 20,000 would be recorded there. And then the other side is to remove that excess from the investment in. Okay, so now we have a few other things. There were some dividends, so that would have gone to the parent. So let's get rid of that. And that's going to go against the investment account because that's where it was recorded at the time that it was paid out. Okay, we've eliminated the dividends. Now let's eliminate the income, equity income in the subsidiary that the parent recorded. And that's going to come out of the investment account. So there's your I entry. We have one more entry to do, which is to do 1 more year's depreciation on this equipment. And so we know that's 4,000 a year. We'll put that up here under operating expenses. Sometimes they give you a line for depreciation and amortization separate from operating expenses, but if they don't, just put it in operating expenses. All right. So then before I start doing the math, I always want to check to see if my debits equal my credits and all these. In fact, I really like to do it as I'm doing my entries so that I can immediately notice which entry's off so I don't have to keep hunting. So that would have been a better practice. Okay, so my debits equal my credits, so that part is good. So now I'm going to add up my credits, add debits minus credits. And so there's my little income statement there. And then this, of course, is a vertical rather than a horizontal total here. Okay. If you put subtotals here, then you can't check for debits and credits. And so once you have these entries, then you have to go down vertically to get this subtotal, because as you can tell, it's not including the 4 and the 5,000 here. All right. You can always go back and add the subtotals once you've checked to see if debits and credits are working. I don't do it, but you can. And then you can crosscast if you want. Okay, so we can do that again here. The net income comes from above. It is not crosscast. Okay, and dividends paid will, of course, be just the parents. And this is also vertical here, not crosscast. Again, because the subtotal here doesn't include all of the activity that would have impacted retained earnings in the journal entries that you booked for consolidation. So just heads up there. Okay, and then for assets, let's see if our balance sheet balances, fingers crossed. So the investment subsidiary, all these lines here belong to that one account. So I can't use, the regular math. I have to do that one manually. So this plus that minus these three things, hopefully a 0. Okay, good. That's the beautiful thing. Now I'm going to do a vertical and see what total is. Retained earnings comes from above. It does not come from a horizontal crosscast. So one of the ways that you get used to the consolidation worksheet is you get used to when you add, subtract horizontally and when you do it vertically. So the ones that are done vertically, I'll make in yellow here to remind you, this comes from above. So just to highlight it for you. Okay, let's see if our balance sheet balances now. And it does. Great. So you're ready for the next one.